Welcome and thank you for standing by. At this time, all participants are on a listen-only mode until the question and answer session of today's conference. At a time, to ask a question, please press star 1 on your phone and record your name at the prompt. Now, I would like to turn the call over to your host, Mr. Mike Wilson. Sir, you may now begin.
Hi, thanks very much. My name is Mike Wilson. I head up the Consultant Relations Group for Morningstar's Investment Management team, and my role is to work with consultants to make sure that they understand the types of products and services that we can offer to their clients, the plan sponsors. This includes Morningstar's target date funds based on the Morningstar Lifetime Allocation Indexes and our managed account platform, as well as some of our financial wellness offerings. I'm really pleased to be here today with my colleagues David Blanchett, who heads up our research group for the Morningstar Investment team, and Dan Bruns, who heads up our large practice group. Both were integral to the research that we will be discussing today, research that's going to really open the door to actionable items that will lead to better outcomes for participants. But before I pass the baton to David, I think that it's important for us to step back and think about what's the goal of a defined contribution plan. Really, in the simplest terms, when we think about it, it's to help participants prepare for a successful retirement. And what is the most effective way to accomplish that? Really, we think there are 3 considerations. First is the savings rate, second, the retirement age, and third, and probably the one that gets the most interest, is allocating properly the investments. To be honest, Morningstar is probably best known for the investment piece of the puzzle, but today we're going to spend some serious time on plan design decisions. And these decisions that plan sponsors can make really can have a big impact on the outcomes for their participants. So with that, I'm going to pass it over to David Blanchett.
Great, thanks, Mike. So in today's presentation, we're going to cover these 2 new pieces of research. And this is part of the presentation, but not all of it. And there's really kind of 5 key messages or actions in today's presentation we're going to cover. The first is rethinking about the optimal default. We've all seen this massive growth in default investments over the last 10 years. And a really important question for plan sponsors is what is the right default for me? And I think that for example, too often today, a plan sponsor may say, I'm going to use a target date fund because that is what everyone else is doing. Well, Dan's going to talk about that here in a minute, but I think that there really are different things to consider when picking that default. The next piece is on plan savings rates, right? When you think about the drivers of outcome, Mike mentioned retirement age, savings rate, and investments. Savings rates is very important. And so things that you can do as a plan sponsor to improve savings rates are very important for the outcome, but it's often kind of overlooked in terms of thinking about the plan holistically. And the next piece ties into that, right? What are the decisions that you can make to affect savings? And a really key thing here is around automatic enrollment and selecting the appropriate default amount. Now, the fourth thing then is really kind of thinking about the cost or benefit of providing these services. If you think about, I want to improve an outcome. I want to help my participants retire. Doing so usually requires costs. And so when you have a strategy, a goal, objective to improve savings, an important question is given the expectation, is it worth it? We'll provide some framework around that. And then finally, we'll cover this idea of how do you think about the core menu today, right? Obviously a big part of today's presentation is about default enrollment and automatic enrollment. And the approach we take towards thinking about the core menu has changed. In the past, we had this perspective that perhaps you wanted to kind of minimize the core menu because of poor choices by participants. Well, right now, though, we aren't seeing that. As people move towards plan defaults, it changes the role of the core menu for participants today. Now, when thinking about all these different solutions, especially the investment, we like this perspective of the advice continuum. And what this is trying to show you is this kind of continuum of possibilities. If we move back in time, let's say 10 or 15 years, the DC marketplace was driven by self-selection, right? We effectively forced all participants to build their own portfolios. And that was kind of widely hailed as a bad idea. And so we've kind of moved to the right slowly, right? With the adoption of the Pension Protection Act in 2006, we've seen an increase in the utilization of target date funds, right, especially off-the-shelf target date funds. And as you keep moving further to the right, though, you move from target date funds to managed accounts, you increase the customization of the solution, right? Because I think that if we can remove cost from the equation and think about what would really help drive better outcomes for participants, the best solution would be for each person to sit down every year for 2 hours at least with the certified financial planner and go over their goals, their preferences, and all their information, and then get a customized recommendation, right? Realistically, though, the cost there is quite high. And so while we think that would be a great solution, we're kind of maybe caught between today using targeted funds and managed accounts, again, based upon the cost. And this is something that Dan's going to mention during his portion as well, but I want to highlight one important point here. You know, when you see research and thought leadership from providers of different solutions, like targeted funds and managed accounts, usually the conclusion is similar to whatever product that company is offering. At Morningstar, we offer all these services. We offer target risk funds, target date funds, a custom target date and managed accounts. And so we really are objective in our perspective about what is the true driver of outcomes for participants. Now, when thinking about this, I think that it's important to kind of think about this idea of the engagement spectrum as well, because participants aren't all the same, right? What they want to accomplish is different, and they're going to get there different ways. In our experience, and this obviously varies by plan, there's a breakdown between those that want to have it done for them, those that want help, and those that want to do it themselves. Right? I think that, you know, for those of you who are plan sponsors on the phone, most of your participants you've seen want to have someone do it for them. They are unengaged, and this is where defaults are key, right? The next is this group of individuals who are somewhat engaged, but not completely. They want to possibly, you know, reach out and get guidance or assistance from someone, and then there is some minority, say 10% of participants, who want to do these things themselves, right? And we think that that's great because that's how our system works. And so when thinking about what is the best solution, think of these three different groups because each of them wants different outcomes and different solutions.
So before we continue on, I want to pose the question of what is the purpose of a plan default today? Is it purely an investment decision? Can it also impact savings rates? Can it impact retirement readiness? Can it be part of a larger financial education and financial wellness strategy? The Pension Protection Act of 2006 opened the doors for 3 plan defaults, 2 of which have seen significant traction and are very popular options today. First, and the early clear winner, is the target date fund. Today, target date products have about 85% of plan sponsors using them as their QDIA. In the far second place is a managed account product. Managed accounts today have about 5% of plan sponsors using them as a QDIA. Now, I want to level set and say that in 2006, managed accounts were probably not a very viable option for a QDIA. They were very expensive, they were very clunky, the user experiences were not very robust, and their integrations with record keepers were not very robust either. But a lot has changed since then. And we've also seen this explosion of robo-advisors, these robo-advisors that are delivering high-quality investment advice. All of a sudden, people are very comfortable getting and receiving financial information and sharing financial details online, and this will be a nice tailwind for these managed accounts programs in the coming years. Before we continue on, I think it's important to look at each solution a little bit further and talk about advantages and disadvantages of each. So starting with target date funds on the left, some advantages are they're very simple. Is a plan sponsor, every participant in your plan, based upon their retirement age, goes into a specific target date product, a vintage within that product, and they stay in that vintage from that point until retirement. That product automatically de-risks over time. It has an asset allocation strategy associated with it, so it's a very simplistic investment option for both the sponsor and the participants. Secondly, everyone's doing it. And so whether this is true or not, there is this illusion of safety from a litigation standpoint that everyone is using target date products, and so if you're just one of the herd, why would you be singled out? Cost is also an important consideration, as David mentioned earlier, and target date funds are reasonably cheap investment options. The price range for each target date product does span considerably, depending on if you want all passive solution or an active and passive solution or a purely active solution, but by and large, target date products are relatively cheap. And finally, there is a potential there for customization. And although we don't see this very large, especially in the mid and small markets, there are semi-custom target date funds available, and there are applications where you can fully customize the target date experience for your participant population based on your plan demographics. There are some disadvantages with target date products too, the main being lack of understanding and misuse. So at Morningstar, we have the ability to run a plan analysis feature where we actually study the utilization of your target date products in your QDIA. And what we often find is that participants mix vintages of target date products, so they might hold a 2030, a 2040, and a 2050 fund. And they also mix target date products and mutual fund products together, potentially negating the features of asset allocation, diversification, and de-risking over time. Target date products can also be difficult to benchmark. And so you may think, this investment strategy that's somewhat simple and regulated would be easy to compare against others, but the reality is each target date provider has different glide paths, different asset allocations, and those may not jive with what benchmark you choose to use. Although not as much problem recently as it's been in the past, there are target date families that either use their own proprietary products within the solution, and they choose to use maybe new funds or new managers and help establish or seed those funds. And there's also a problem that target date providers might use a single family of investments only within that product. And so you're really not getting best-in-class thinking and best-in-class products underlying fund exposure. You are getting that provider's family only. And finally, this is probably one of the biggest ones here, one size fits all. So whether you're a physician, a CEO, or someone working on an assembly line making $10 an hour, your asset allocation is exactly the same. And we know that people are personalized, and having a generic asset allocation for vastly different scenarios is not appropriate. Moving to managed accounts, some advantages. You have the ability to see the complete retirement picture. And so, kind of combining points 1 and 2 here with a greater level of personalization, we have the ability to receive, somewhere between 5 and 6 and 12 data points for every single participant in the plan on a quarterly basis. That data is consistently being updated and refreshed. And so having that very up-to-date, relevant, and pertinent information for each participant in your plan allows us to develop a very nice retirement picture and a very nice asset allocation strategy for them. Obviously, along with that, they get a savings rate recommendation and a retirement age recommendation. Retirement income modeling. When you think of the DC industry as a whole, I think we do a pretty good job helping people accumulate assets. But once they reach the retirement age, oftentimes we say good luck, and we send them on their own. Within the managed accounts program, you have the ability to strategically accumulate assets and also decumulate assets in a strategic manner. And so only a solution of managed accounts where you can meaningfully accumulate and decumulate assets. And finally, using the investment options on the core menu. So plan sponsors and consultants spend quite a bit of time designing these core menus. They spend quite a bit of time reviewing them. It only makes sense that you would use these. If you use a target date product, the reality is 80% of your assets are probably going to stay in that target date product. And there's going to be a very small portion of your participant population that uses the core menu. The managed account program will utilize that menu that you've done so much work to build. Disadvantages: managed accounts programs, by and large, are more expensive than their competing target date products. And there is no two ways about that. But I would argue you get more for that.
Dan, what are some costs for managed accounts we see today?
As far as a generic cost you might see for a product? So it really depends on how it's used. There are differences if it's used as an opt-in or an opt-out situation, so as the plan's QDIA or as an opt-in basis. But typically managed accounts fees will range somewhere between 35 and 55 basis points depending on the size of the plan and how it's used. Due diligence is somewhat of an issue amongst managed accounts programs. There are only a few key providers, and so not every provider is very transparent about how their programs work and how they might recommend, and so there are some problems from a consulting standpoint of doing due diligence against them. Performance reporting is somewhat of an unknown, and so if you think about your participants in a managed accounts plan, you very well could have, for 100 participants, 100 different portfolio recommendations. How do you choose portfolios to do performance reporting and benchmarking against? And there's obviously unknown information. So although engagement numbers amongst participants in managed accounts programs are increasing steadily, and again, largely probably attributable to the comfort that participants now have getting and receiving financial information online, there is unknown information for many participants. And so as an industry, I think the managed accounts providers are working towards closing that gap, but we only know what participants tell us about. And so there could be unknown information that might otherwise influence those recommendations. Looking at differences in key participant demographics between those that use managed accounts and target date products, we see some very surprising things. And so first and foremost, one of the first things we noticed in the recent paper we wrote is that participants in managed accounts actually saved more than those that use a target date product, about 2% more. And that absolutely shocked us. We were not expecting that. We fully expected the savings rate to be constant for both solutions. Whether a participant enrolls in managed accounts or a target date fund, we didn't think the choice of a QDIA would have a significant impact on participant contributions. Now, there are a few reasons, other than just the managed account product, that could be responsible for that. When you look at other demographical attributes shown below, such as age, tenure, salary, and default savings rate, you see that for plans that use managed accounts as the default, participants tend to be a little bit older, with the plan a little bit longer, and earn slightly more. Looking further at savings rates, we see for target date funds versus managed accounts, at each age group, participants in managed accounts tend to save more than those that do in a target date product. And again, this was very surprising to us. The difference is the savings rate is typically bigger for older participants and smaller for younger participants, the difference between the managed account and the target date product. Not surprising, and obviously realizing that those participants who are younger, that change in savings rate now has their entire careers to compound and make meaningful differences for their retirement income.
Yeah, one thing I want to add on this slide in this differences, just to kind of provide more backdrop, is that these are individuals who were mostly defaulted in these solutions, and so they were defaulted into a target date fund or managed account, and so you wouldn't expect someone who is effectively unengaged, they defaulted in the respective solution, have different savings rates. But as Dan mentioned, what we're very surprised to see is that there's a very large gap. On this slide, you see that the difference between individuals and target date funds versus managed account, it's about 1.5 or 2%. Now, what's really important to know with this information is that most of this difference can be described by the attributes as Dan mentioned. So, again, as Dan said, the individuals or the plans that have managed accounts tend to have older participants who make more, who've been there longer. But even if you control for all those variables, this difference still persists. So we did find this really surprising difference, this meaningful difference in savings rates between the two solutions.
So I think we're going to come back and talk more about this later. But there's another piece of the QDIA decision that's important to study, and that's really the asset allocation decision. And so what drives the investment decision within your default solution? Looking at target date products, it's very simple. It's the participant's retirement age based off their current age. Custom target date products take that definitely a few steps further, being able to incorporate industry and plan-specific attributes as well. So for example, do you work in oil and gas? Do you work in finance? Should your portfolio have different exposures to it because of those attributes? It also has the ability to consider plan-specific attributes such as defined benefit plans, very generous, employer matching or ESOP plans. So having more of a customization for that plan, but still treating every participant in that plan generically. The managed account solution clearly represents the most robust solution, considering 9 data points in this case for each participant. And so with this data, we have a very good lens to look into each individual investor and see key differences amongst their demographics and then sculpt their asset allocation and savings solution around that. For example, a data point like what state you live in may not seem impactful, but it has major implications on taxes. And so that data is key for an investment decision that we make, and really more of a financial planning decision. So now that we've talked about the data used for each solution, when you read about how target date funds are built, focusing on that for a second, they often talk about being built for an average user. If you read prospectuses, it talks about an average user. And so I want to talk for a second about what that average user is. The average user has an average balance, an average pension, an average retirement age, savings rate, gender, and income. And the reality is the average user isn't anybody, right? Everyone is unique, and we know that. And so let's look at how the average user is allocated versus someone in a managed accounts program where we have all that data to consider. So here we have equity distributions for participants who are defaulted into target date products. Now, it shouldn't be surprising to anyone that it's a fairly tight range of equity allocations across the board, right? It's not a very big band. There are some drops in the glide path, but that's truly a product of the different target date series levels in which they de-risk or the different glide paths they take. Now let's look at participants in managed accounts. As you can see, there are significant differences here, right? And those differences compound as you age. And so the key here is that managed accounts participants who are defaulted, right, where we're only getting basic data for them, still see significant differences in their asset allocation strategy based on that key data. And so basic data makes a difference.
Dan, I'm curious, why do you think it is that we see this increasing distribution of allocations for managed accounts versus target date funds?
Well, we know that participants are very unique, right? And personalized data about them changes a lot, especially as they tend to get older. And so being able to consider that data and look at every participant uniquely through this very deep lens tends to have more refined allocations. So this is, again, participants who default into the solutions, right, and are unengaged users. If we look at participants who engage, and I'll explain this chart in a second, we see much greater distribution. So these blue circles here represent individual participants in a plan that uses managed accounts. This is a plan that's been live with managed accounts for about a year. Managed accounts is used as a default solution. Age is along the x-axis at the bottom. Equity goes along the y-axis. What you can see is the participants in managed accounts who have engaged with the solution have very, very personalized investment recommendations. And so this is after participants have come in, entered their additional details, information about spouse or partner, and really customized the retirement strategy for them. The result is, again, very personalized recommendations, again, with savings rate and retirement age advice.
Great, thanks, Dan. So, Dan just covered part of the findings of this research piece that we just put out, I believe, a week or two ago. And again, the impact on savings rates across the two solutions, target date funds and managed accounts, was quite surprising, right? We've always known that there's been a difference in the asset allocations in managed accounts versus target date funds, which Dan also covered. But the differences in savings rates kind of surprised us. Well, there was actually kind of a bigger finding that was even more surprising, which was the impact of the default enrollment rate on overall plan savings. So, many plan sponsors have adopted automatic enrollment in a goal to increase participation. The numbers vary by survey, but if you rely on voluntary enrollment, where people have to elect or opt into a plan, you see participation about 75%. Right? If you have a plan where it's automatic, it usually exceeds 90%. An important question, though, is, well, what does the actual default enrollment rate, how does that actually affect savings? And what you'll see in this slide are two lines. And to be honest, the most important part of this graphic is where the lines cross that zero line, okay? And what that's saying is at what default enrollment rate are savings rates higher because you did the default versus voluntary enrollment? And so what you see here is that about 6% is where the average savings rate is higher for plans that have automatic enrollment versus voluntary enrollment. And so what this suggests at a super high level is that if you have a plan and you're defaulting participants at 2 or 3%, you're going to result in a much lower savings rate than if you force participants to do it themselves, right? And this has to do with things like the endorsement effect. If a plan sponsor has picked a given target date strategy, a given default enrollment rate, the average participant assumes that's what's best for them. And so it's important to kind of ask the question, well, what can I do to actually improve the default, right? So, we are big believers in automatic enrollment. We do see that it does have a very positive impact on participation rates. However, you have to select the initial savings rate or the default savings rate intelligently, right? And so we believe that if you're going to actually have this automatic enrollment, the minimum savings rate should be 6%. Because if you do less than 6%, what we found is that savings rates actually decrease. Now, it's true that, with automatic enrollment, more people actually in the plan itself, but they're not going to be saving as much on average. And, we think 6% is a great starting point. We're a bit disturbed by the actual enrollment rates being used today. So what you can see on this slide is information about the default enrollment rates across plans. And what we see, both in our test data set, which is about 200 plans, and a Brightscope database, which is over 20,000 plans, is that the vast majority of plans today are using 3% as their default enrollment rate, right? Less than 10% use a default that is 6% or higher. And so, again here, certain things are important. I'm going to actually talk about in a few slides the relative importance. But if you're going to have automatic enrollment, it is absolutely critical you select a default rate that is reasonable. I know that a lot of plan sponsors say, well, we use 3% because we're going to bump that up by 1% per year. We're going to introduce progressive savings. We're going to say, okay, they're doing 3% in year one, then they move to 4%, 5%. Well, the median tenure among workers in the U.S. today is a little less than 5 years. And so here's the thing. If a participant defaults in your plan at 3%, and they increase by 1% per year, and then they move to a new employer who's also doing 3%, and then they bump 1% per year, they will never get to a even reasonable savings rate to achieve retirement success, right? This is absolutely critical in thinking about how do you improve outcomes for participants. Now, we just talked about kind of savings rates, and so, a key thing here is kind of to bring it all together, to kind of ask the question, what can you do that is easy, and what can you do that is actually more difficult? And so this is kind of our perspective on different outcomes, right? So if we think about what would the deferral rate be if you enroll at 3%? Well, we estimate it's about 4.9% on average. It's quite low, okay? If you increase that from 3% default to 6%, we expect that actual average savings to go much higher, to say 6 or 6.8%. You can do other things as well, though, right? You can do things like progressive savings. You can do an annual look back where you effectively re-enroll the plan and force participants who aren't enrolled to re-enroll because, we just went through re-enrollment for health insurance at Morningstar this week. We had to make an elective decision about what we're going to choose to do for our health insurance. I think a problem with defined contribution plans is that we only make the decision when we first start working. And while that's good, a better approach is to make people revisit that over time. And then finally, we find that adding managed accounts does add value. So in this example, we're saying that we'll see savings rates rise from say 10% to 10.3%, and this is also meaningful, but other things perhaps can matter more. So again, all these things we see can add value, but to varying degrees. Now, an important question then is what is this worth, right? So hypothetically, what if you can do something to improve the savings rates for participants? What is the value of that? And so, in this research, for example, we found that participants who are defaulted in managed accounts tended to have higher savings rates than those who are in target date funds. Now, as Dan mentioned, there is a fee for managed accounts, right? If you're going to do different activities to boost enrollment, there could be fees for those. And so an important question is what would the fee have to be to eliminate the benefit of higher savings rates, right? So let's just say, for example, that we know for a fact that if we introduce managed accounts, we're going to increase savings rates by 50 basis points, okay? We obviously don't know that, but we can actually estimate, well, what would the fee need to be to eliminate that value? Right, so what we see on the slide is different kind of highlighted areas. And so if we focus on that green box, okay, so what this green box is, it's saying, well, if someone just enrolled in the DC plan, they have no rollover balance. They're in the plan for 10 years, right? If you can increase their savings rates by 0.5%, so going from, say, 5% to 5.5%, and they maintain that over that 10-year period, that is worth a fee of 1.1%. Right, and I think why this is important because it kind of sheds light on the actual value of these services. If you can do things to increase the outcome, it is very valuable, right? Now, the equivalent fee that would kind of eliminate this benefit of higher savings obviously declines at higher balances, right? So if you have participants who have a rollover balance or you're doing a limited enrollment, the actual fee you can charge to get this boost in savings decreases, but it's still very meaningful. But, with all this, one thing to kind of think about here is that when you talk about fees, there are other forms of value at play here, right? And when I think about value, I kind of like to ask the question, how do you want to spend your alpha, right? And when I talk about alpha, we often think about investments, right? I want, as a plan sponsor, to select investments who outperform their peers. Right. Well, for those of us that have been doing this for a long time, we know that investment alpha is highly uncertain. Right. It's very difficult to select investments who consistently outperform their peers. It's very hard to do. But it takes time and it takes effort. Right. In my opinion, if I'm a plan sponsor and I have a limited time budget, I would rather spend my time on doing things that create a more certain, better outcome for participants, things like financial planning. Right, and if we go back 10 slides, there's that slide that showed the spectrum of outcomes. Well, improving the investments will lead to a good outcome, but our research suggests that helping people understand how much to save for retirement, how much they should be saving when they should retire, leads to better outcomes. And we actually did research on this. And so what we did is we looked at all the participants who utilize our managed account services. Right? And so we asked the question, well, what percentage actually increased their deferral rate after receiving our investment or savings guidance? And 87 participants saved more for retirement. Right? And to me, this gets to the idea of a investment product versus investment solution. Right? As Mike mentioned when we first kicked things off, the goal of a DC plan is to help participants retire. And in my opinion, the place where we're lacking today is in savings. And we saw previously that participants who are defaulted in managed accounts tend to save more. What we find that's even more impactful is when they engage with us, they tend to save more. Now, 87% save more. The average savings rates increased by 28%, right? This is a relative term, and so for example, they moved from about 6% to 8% on average as a percent of their pay. So again, people that engage with advice and managed accounts really do see a better outcome from the perspective of they are saving more for retirement. It is driving a better possible outcome for participants. Now, taken together, right? This results in more wealth during retirement, right? So we ran different projections, and we found out, if you can just increase savings rates, as we saw on average, this results in 40% more income for the average person who's in the service over time, right? We model the fee, we include all the different costs of services, but at the end of the day, value is accomplishing the goal. And in our experience, providing advice or managed accounts helps someone get there. And, we actually kind of had some research about this, and it was about Gamma. And Gamma, it's the third letter in the Greek alphabet. It goes alpha, beta, gamma. And this is a piece that came out about 2 or 3 years ago. And the goal is to quantify the value of financial planning, right? Because, again, we quantify so many things. We quantify beta. We quantify alpha. We do these things. But in reality, getting to the goal is the most important thing. And in this piece that I wrote with Paul Kaplan, we explore this topic. There's been other research on this topic. Vanguard has Advisors Alpha. InvestNet has Capital Sigma. There's a lot here just saying that when you look at the cost of a service, so for example, working with a financial planner, you shouldn't just ask the question, is this individual, is this advisor helping me build a better portfolio? It's what are all the things they're doing to help me kind of accomplish this better outcome? So with that, I'll pass it over to Dan to talk about the core menu.
Thanks, David. So shifting gears a little bit and focusing on the core menu, I really want to ask you, what is the purpose of your core menu today? And so I think at a high level, you would probably say, the role of your core menu is to provide investment options available to your participants. And that's great. But we know that 70 to 80% of participants in your plan are using the default, right? We've already established that if they're using a target date product, they're not building off of the core menu. So let's look at the differences between participants who are defaulted into the target date product and those that choose to opt out. And so here I show you two users, or two demographical details for two users. One who uses a target date product and one that does not. So the one that uses the target date product, that represents an unengaged user. They were defaulted into that solution and they stayed there. The engaged user, the one who opted out of the target date product and is in choosing to do something else, these users have very different demographical details between them. And so when you look at these details, the age being 8 years older for the user who engages, saving 6% more, earning $25,000 more, having a balance of 800% the balance of the unengaged user. These are big differences. And what this tells us is that that user who is engaging, right, that does not use the target date product, is likely a little bit more sophisticated of an investor. And so I'm going to come back and talk about these investors, but real quick, I want to talk about the number of investment options that are available on DC plans today. And so what we have here is a chart of the number of investment options available by time period, so the past 10 years, as well as plan size, so all the way from micro plans to very, very large mega plans. And although we still see differences in the number of investment holdings, small plans have tended to add to their core menu, larger plans maybe even detracting a little bit, but by and large remaining fairly constant at about 20 investments per plan. The question is, are these investments necessarily the right choice for the participants within your plan? And so while plans may have a lot of funds, 20 funds is quite a few funds, it doesn't necessarily mean that they're well diversified. These holdings within these core menus tend to be largely U.S.-centric and lack fixed income diversification. And so I realize that we track a U.S. retirement liability. So having U.S. exposure obviously makes quite a bit of sense, but you also need diversification. And right now, the average menu has 3 international funds available for every 9.5 U.S. funds, and that's a problem. Also, very few menus have any type of fixed income international exposure. Even the domestic fixed income exposure can be quite lacking. And so looking at 4 sample core menus here, I have a very basic, moderate, and complex. The very basic represents the minimum you need to be 404C compliant, or excuse me, the very basic. The basic adds the U.S. equity exposure, but doesn't expand on it quite a bit. Also adds some international exposure. The moderate is probably more representative of an average core menu that we would see in a plan sponsor, having well thought out U.S. equity exposure, some fixed income exposure, maybe an optional asset class or an alternative, and the complex obviously being a very advanced plan that has very good exposure across U.S. and international fixed income, emerging markets, and quite a few alternatives as well. This diversification that you see in these more complex menus allows for an individual who's opted out, right, an engaged user, or a service provider, so a managed accounts provider or someone using your core menu to build custom target date products, to build a better portfolio. And that better portfolio, that diversification can have a real meaningful difference on the risk and return of a portfolio versus its less complex, other less complex menus. And so when you look at the impact of that on a trade-off between risk and return, what you effectively see is that this diversification of these more complex menus bows out the efficient frontier. And this chart represents that, and here we're using Morningstar capital market assumptions. But you can see that these more complex menus actually add return for the exact same unit of risk. And you've probably full disclosure, most of everyone on this webcast has probably seen a chart like this before. As you add additional asset classes, it creates a better portfolio. But let's look at the compounded return. And I think in many ways this is more meaningful because as you can see, the more complex portfolios have higher level of returns for any given level of equity risk. And when you look, moving every level of portfolio sophistication you increase, you're adding 0.5 to 1% compound return for the exact same level of risk. And when you think about it, what does the difference, what impact does 1 or 1.5% of additional return have when you look at someone investing over their lifetime? Well, it can be quite meaningful, right? And so over an investor's lifetime, the difference between a very basic, moderate, or complex portfolio can be quite profound. And the key here is that 1% more per year really does result in meaningful differences for an average participant. So a few conclusions from today's webinar. We spent quite a bit of time talking about research and how that research impacts core menus and ultimately participants. But every investing proposal or every investing system has to have a balance between art and science, right? And the research, the quantitative aspect of this is definitely the science. But there's also an art to investing, right? And the art to investing is understanding your participants, your plan, and your experience with those participants. And this is really where a consultant or a plan sponsor who's very engaged with the plan can add quite a bit of value. Together, these two solutions create the best participant outcomes. So, a few parting thoughts. There's been quite a bit of research on QDA options, and there's been quite a change in QDA options available. As I mentioned originally, a lot has changed since 2006. And although target date funds were the early winner out of the gate, I don't know that that's always going to be the case. David showed this trend towards more personalized solutions, and we're absolutely seeing that today. And so although in 2006 managed accounts may not have been available or very attractive options at QDA, today that's no longer the case, and it should be considered and evaluated just like other target date products should. Savings is critical, and there's a lot of research that shows that automatic enrollment improves participation, but you need to pick the right savings rate. At least 6% based on our research. Any less, and your participants will actually be saving less than they would if they self-selected a contribution rate. Plan design features such as annual lookbacks, progressive savings rates, and automatic enrollment are obviously important. As David mentioned, he made his health insurance selection. I did the same. Forcing participants to re-enroll and re-engage is a good thing, right? I think a lot of times participants engage and they stay in that allocation forever, and that's not necessarily creating the best outcomes for them. Now, realizing, we've just talked about these previous things, we realize that they have costs, right? Nothing happens in a vacuum. But the important thing is looking at the cost to benefit value, right? For example, managed accounts or implementing an annual look back may cost money, but it could very well be worth it, right? Don't just focus on the cost, focus on the perceived value or value your participants also get from these solutions. And finally, the purpose of the core menu has changed, right? We know that the bulk of investors use a QDIA solution and stay in that solution until they leave the plan. So build the core menu for those investors who are choosing to do it on their own, or the service providers that are using that menu to build portfolios for your participants. Adding more complex asset classes benefits everyone. The perception 10 or 15 years ago of choice overload causing participant inaction is no longer the case thanks to QDIAs. I think we're going to open it up for a few questions. So the first question we have is, how does page 16 differ if someone is defaulted but does not engage? So let's go back to page 16.
I think that might be,
okay.
Might have meant 15.
Oh, I'm sorry, 15. Yes. So here we show participants, 15. Okay, so these are participants who were defaulted but did not engage in the managed account program at all. So these are participants that were automatically put into the managed accounts program, never went in, never add additional information. All we're using is the basic data that we talk about here, right? These 9 to 12 data points to drive these default or these investment solutions. And so even with that basic data, we can provide very tailored advice.
Great. And this is a question that I've heard before from consultants. David, maybe you can speak to this. Kind of talk about the difficulty of benchmarking managed accounts platforms and target date funds.
Right. I think that it's actually difficult to benchmark both. There's, often a misconception that maybe target funds are easier than managed accounts because there's a population of funds. And so someone may say, well, I can just compare the performance of the Vanguard fund versus Fidelity or something. And, my perspective there is that, for both solutions, there's kind of 3 levels of the process. The first is, how do you determine the asset allocation, right? So that would be effectively the glide path for each. How do you then kind of allocate, across the actual asset classes? Are you using small value or large growth? Then how do you actually build out the underlying fund menu? And, while there are ways to kind of compare targeted funds, it's more difficult to manage accounts. One thing that we've done in the past is possibly select portfolios that are representative. So, for example, what is the average portfolio being held by a 65-year-old, and what is the performance of that? I mean, Dan, do you have any thoughts at all on that topic?
No, I think just to expound on what you're saying, we're realizing that we have to come up with some type of performance attribution solution. It's only fair that a plan sponsor or consultant who is evaluating us be able to look at the portfolio performance in these portfolios, these investor portfolios. And so what we're doing is we're looking at the average participant and obviously creating synthetic benchmarks that match that plan's level of risk, right? So it's not fair to compare a plan that may be more conservative on average based on, specific attributes about that plan, for example, a defined benefit plan or, a very aggressive company match, to an S&P 500 fund or a very aggressive target date benchmark. So the key is lining those up appropriately, and I think that's something that, we continue to work on over time.
Great. Another question that came in. So can you talk a little bit about how engagement affects the value of managed accounts for participants?
Right, Mike, that's a great question. This is a question we get all the time. And again, I want to reiterate, as a firm, we offer an array of solutions. We offer target date funds and managed accounts. And they both have a place for different types of companies, right? At the end of the day, a plan sponsor is charged with deciding, what is the best solution for my participants? And kind of like any other, service that's out there, the more that someone engages with the actual solution. So this to be managed accounts, the greater the value. Now, as Dan pointed out, it's not to say that if you don't engage, there isn't much value, because we do see this wide array on this side of asset allocations. We do see differences in savings rates. But if you have a plan sponsor really pushes engagement and really gets people involved in providing information about themselves, it really leads to a much better outcome, because we tend to see much higher savings rates, much difference in asset allocation. It really becomes a more comprehensive solution for participants who are engaged.
I think that's it for our questions. Definitely want to thank everyone for participating in the webinar today. David and Dan, thanks so much. Really some interesting research, and we're pleased to share it with everyone today. So thanks again, everyone, for attending. If you have further questions, feel free to reach out to myself at michael.wilson@morningstar.com. Thanks so much.